and members of the public in the chamber this evening. Before we begin the meeting, there are a few housekeeping items I need to cover. Firstly, I need to advise you all that this is a public meeting, which will be live streamed for public viewing, and a record of the decision published the day following the meeting. The press and public are welcome to attend. However, they will be asked to leave when we have to consider exempt information at the agenda number 102 to 113. Exempt information will be considered in a closed session and will not be streamed online. Whilst all are welcome at this meeting, we want to ensure that members of this committee are heard and business can be transacted in an efficient way. We will not allow behavior that disrupts the council business. If after warnings have been given, any disruption persists as chair, I will seek to adjourn the meeting and ask the public to leave the chamber. The meeting will be resumed following the clearing of the chamber, and members of the public can observe the meeting online. It is hoped that none of this will be necessary and that all present are respectful of the protocols in place. I would also like to remind all committee members that you are required to attend in person. For any councillors who are accessing this meeting remotely, I must remind you that you are not counted as being present for the purpose of the Local Government Act 1972, and you may not vote on any item under consideration. You may, however, at my discretion as chair, contribute to the discussion and participate in a non-decision-making capacity. Before we begin the main agenda, I would like to advise that I have not received notice of any questions for this committee. The Constitution does allow for questions without notice at the discretion of the chair. It should be noted that any question without notice may not receive a full response at this meeting, but a written response will follow. I now turn to published agenda item 1. Apologies for absence. Any apology for Councillor Radbourne?
Hayhurst, Councillor Gordon, and Councillor Larson.
Yes. Right. List those attending online. Councillor Ozone is attending online?
Yes.
And Henry attending online as well? Okay. Declaration. Do members have any interest they wish to declare? Members, do you have any interest that you want to declare? No? No? Okay. There's no urgent unrestricted business. Agenda item 4, Chair. The agenda item, exempt item, are set out at item 12 to 15. The formal 5 clear day notice under the regulation to confirm that this pension committee meet will be partially held in private was given. No representations with regard to this have been received. Agenda item 5. Agenda item 5 is deputation petition question from the public. No new deputation were received at the time of the agenda publication. A deputation relating to the divestment of Hackney Local Government Pension Scheme from companies complicit in human rights abuses in the occupied Palestinian territory was previously received. Following a deferral from September and November meeting, this deputation will be held at a future meeting. So agenda item 6, can member agree the public minutes of the previous meeting held on 28 November 2023 as a result an accurate record of proceedings?
Agreed, Chair.
Can we agree the minutes of last meeting, please? Thank you. Agenda item 7. That is over and under payment policy. This report set out an updated over and underpayment policy for review by the committee. The policy was last reviewed in 2021 and is now due for renewal as part of the 3-year renewal process. Rachel, could you please introduce the report? Following questions about debate, ask whether the committee can agree following the recommendation. So Rachel, please introduce the report.
There we are. Thank you, Chair. So this report is an update to the fund's over and underpayment policy. As the Chair has set out, this is a routine triennial update of an existing policy. The aim of the policy is to make sure that under and overpayments of benefits are treated in a fair manner, and that where it's appropriate to do so, we do attempt to recover overpayments of benefits that have occurred. The policy itself is presented at Appendix 1, and this shows a marked up copy of the draft policy, which shows changes relative to the previous version. So the changes made in this iteration include wording updates, improving points of clarification, and just reordering of the content to help make the policy consistent with other fund policies. So new wording in the policy is highlighted in yellow, and anything to be deleted is shown in strike through. So the key changes in this iteration partly concern a new section covering underpayments of benefits relating to McLeod. And then there's some additional wording around making sure that we follow principles in the reporting breaches policy, and also those set out in the Council's anti-fraud and corruption policy. There's also an updated section covering administration and communications objectives. I'm happy to take further questions on the policy if there are any.
Thank you. Are there any questions from members? Questions on overpayment and underpayment policy renewal? I've got some clarification from me, which is when the underpayment is discovered, how quickly is it sorted out?
Sorry, Chair, could you repeat the question, please?
Just for clarification, it's like, say, like there's underpayment, and when it's discovered, how quickly is it sorted out?
So I would need to double check for exact confirmation. Generally speaking, if the underpayment is straightforward, they are quite quickly resolved. We have a recent one that was resolved within a day of discovery. Others have been resolved within a period of a couple of weeks. So it depends on the nature of the payment itself, and how quickly it's practical to resolve. But generally speaking, it is not a long wait.
My second question is about the unauthorized payment. So when you have authorized payment, how do we deal with that, and what impact does that have on the funds, like we have unauthorized payment?
Sorry, what type of payment, Chair?
But unauthorized payment. So when we have that, what kind of impact, and how do we deal with that, and what kind of impact does it have on the fund in terms of tax purposes or something like that?
So the way in which we deal with an unauthorized payment, again, it depends on the nature of the payment itself. Some unauthorized payments will be unauthorized as they are potentially contrary to regulations. Others are likely to. The range of significance of the impact that can vary quite a lot in terms of unauthorized payment. Again, we do look to investigate and resolve quickly where we can.
Any other questions from members? Questions, Jonathan? Yes. Councillor Adebayo.
In the case of overpayment, I know you said you tend to recover that within a short space. What happens if the person that is being overpaid doesn't want to pay back?
So underpayments, we tend to resolve very quickly. Overpayments, and again, it will depend on the nature of the overpayment, but we will accept. We often do enter into longer recovery periods for overpayments, as we recognise that obviously it will depend on the financial circumstances of the person we've paid. It will depend on how long the overpayment has been going on for. So, occasionally, we are informed. Occasionally, we do receive quite late notification of overpayments, and when that occurs, we do have to consider the affordability of repayments and the circumstances of the person repaying. So we are willing to enter into repayment plans, and we have in the past considered quite lengthy repayment periods.
Any further questions from members? If not, the recommendation is for us to approve the reverse policy. Can we approve the reverse policy, please? Yes. Councillor Adebayo agreed? Yes. Thank you. Now we move on to agenda item 8, Competition and Market Authority objectives. This report presents an assessment of Redington performance against the fund aim and objective for 2023 and set out updated objective for 2024. Rachel, I will call on Rachel to now present the report. Thank you, Rachel.
Bear with me one moment, Chair. I'm having a minor technical issue. So this report sets out the CMA objectives for Redington for 2024 and provides an assessment of performance against objectives for 2023. So the CMA order is in place to help address competition issues within the investment consultancy market. Obviously, we do make use of an investment consultant from Redington, and therefore are required to report. So LGPS funds are required. We are required to set strategic objectives for our investment consultants, and there is an expectation in place that we will report performance against those objectives. So the aim of this report is to demonstrate that we have complied with those obligations. So the objectives for 2024 are set out in Appendix 1, and an assessment of performance against the previous year's objectives is provided at Appendix 2, and I'd be happy to take questions on the report.
Thank you for the presentation. Are we done, or Rachel? Are we done, or?
Are there any further questions, Chair, on either the review of performance for 2023 or on the objectives set for 2024?
Okay. Councillor Troughton.
Thank you, Chair. Just with regard to the amber items in the performance monitoring, have you got any concerns that any of these objectives won't be met within a reasonable timescale?
So the amber items included, I take it you're referring to those concerning manager fees, and also those around investment governance arrangements for the fund. So we don't have any particular concerns around either of those two items at present. Obviously we do carry out regular monitoring of the fees that we pay. In terms of investment governance, I would say that is something that I think we would like to look at in greater detail, perhaps over the coming year. It's something that I would anticipate that the fund looks at during 2024, as particularly for some of our larger providers, such as the London CIV. We probably would like to do a little bit of further work on checking the governance arrangements in place, and that is work that I think we would look to Reddington to help us undertake. So it's flagged amber in this instance, as it is something that I think we ought to be looking at, but perhaps haven't focused on this year.
Thank you. Any further questions? No. No. Okay, Councillor Bafo.
Sorry. Yes.
Can you be quiet, please? I'm giving you warning not to disrupt the meeting. If you carry on disrupting the meeting, we're going to suspend the meeting. Thank you. Stop. All right. I have to suspend the meeting now. Thank you. Meeting suspended. I'm going to adjourn the meeting now. Thank you. Thank you. We have to adjourn the meeting. Thank you. 8, agenda item 8. Go on, sorry. Go on, try.
Yeah. So now, yeah, thank you very much, Chair. What I wanted to find out is that has there been any unforeseen circumstances that has forced strategy review along the line where something like maybe COVID or something, and how has been strategy review taking that situation into account?
Sorry, do you mind repeating just the first part of the question? So which part of the sort of in
Yeah,
terms of the
like-
strategy review?
Yeah, it says here. Mr. Please, sorry. Yeah, it says strategic objectives. And I say, what I'm trying to find out is, has there been any situation that has forced to review a strategy at some point where some unexpected circumstances that's taking place?
No, thanks for the question. So I can't think of circumstances in recent years where we've made a sort of radical reactive change to our strategy. Generally speaking, the way we consider the fund's investment strategy is through the triennial review process. So obviously, every 3 years, the valuation is carried out, and then following the valuation, we then begin a high level review of the fund's overall investment strategy. It can be subject to review more frequently than every 3 years. So if there are dramatic changes in economic conditions or something similar, then obviously we do consider whether the strategy is still appropriate for the fund's needs. What we've generally found over the last few strategic reviews is that although often there have been quite substantial changes in wider economic conditions, what we've generally found is that we've tended to make incremental changes to the strategy rather than sort of wholesale reactive ones, if that makes sense. So generally speaking, when we have experienced significant change, we have generally found the fund's sort of high level strategy to have remained robust, but we have sometimes made sort of changes to certain aspects of the strategy. So one example from recently might be obviously the very significant rise in inflation. And what that's done is because it's led to very significant year-on-year benefit rises, it's quite significantly changed our cash flow profile. So we are moving quickly towards cash flow negativity. So obviously we have looked to make changes to the strategy to help address that. So moving towards sort of greater income generation in our investments. But what I think we have found is that that's actually something that it isn't actually simply a recent change that we've made since the rise in inflation. So it's not been confined to the last couple of years. It's actually something that we've planned for quite a long time. We were already starting to make incremental changes towards trying to generate increased income. And what we've found we've done is perhaps speeded that process up as a result of the changes that we've experienced.
Thank you. Councillor Adebayo.
Thank you. With the rating performance, I noticed that you have some color code, the key. So when doing the presentation, so do you normally do the color coding, that will allow us to know how the objective and the expectation, how they are performing?
So I would say performance against objectives for 2023. If you look through the colour coding, you can see that it's performance has been generally good. So there's, I would say the majority, we're looking at good performance. There are some areas there highlighted in green for excellent. And then obviously, as we've discussed on one of the previous questions, there are a couple of areas that are flagged as amber. And those are largely the results of topics that we have perhaps not considered in significant detail this year. So in particular, that focus on investment governance arrangements.
Any further question from members? Jonathan, happy? Councillor Chapman, happy? Okay. Are we, is there anything going to speak to their performance, or is that it? Rachel? Because we have two recommendations: agree the objective set out in Appendix 1 for the fund investment consultant during 2024. Note the assessment of the performance against objective for 2023 as set out in Appendix 2. So are we approving both of them together? Are we doing it together or just the first one? Questions?
I'm sorry.
Sorry, can you repeat that into your mic?
Sorry, couldn't turn my microphone on. If there are no further questions, are the committee happy to agree the two recommendations set out in the report?
Just want to clarify that. That's why I don't want, last time, what happened last time was I was going like an express train and missing something out. So that's why I'm clarifying that. So committee, could you please agree the following recommendation? 1, agree the objective as set out in Appendix 1 for the fund's investment consultant during 2024. Note the assessment of the performance against objective for 2023 as set out in Appendix 2. We agree?
Agreed.
Thank you. Move on to the high-level performance report, page 61 to 76. This report is a high-level update on key strategic pension fund matters, including progress against the business plan, strategic objective scorecard, risk register. It also includes breaches of the law. It provides the committee with latest information on the position of the fund since the report at the last committee. An overview of each area is given in the main body of the report, and further details can be found in the appendices. Rachel, could you please introduce the report, please? Thank you.
So as the chair has set out, this is the high-level monitoring report. Please do let me know if there are any questions concerning this report. Otherwise, I'm happy to largely take this as read. There are a couple of areas that I'd like to just highlight to the committee. One is the absence of budget reporting for this quarter, which is as a result of our recent custody transition. So this is reporting to the end of September 2023, which is the period covered by our switch from HSBC to Northern Trust. We do hope to have updated budget monitoring with you as soon as possible. But we are, because we've had quite significant delays to the audit of the accounts, we are running a little bit behind in terms of carrying out the double set of quarter end processes that we need to reconcile for this period, as we're essentially working with two sets of custodian records. So I wanted to bring that to your attention. The only other item really I think to highlight on here is the breaches reporting, and to note that we hope to hold a meeting of the pensions board as soon as possible. Does this pertain particularly to the budget reporting or to the pensions board? No problem. So I'm hopeful that we will hold a further meeting prior to the end of March, not least because we are required to hold 2 meetings a year. We have reported to the regulator that we have missed a meeting. If possible, we would obviously like to make sure that we are holding a further meeting prior to the end of the financial year. Obviously, if that does not happen, we will make a report to the regulator. We will make a further report, but it is my hope that we will have held the meeting by then, and we will update you on the date as soon as possible.
Adebayo.
If I go to F4, the Responsible Investment and Stewardship Code, Q1 was outstanding, but Q2 and Q3, just wondering what happened that, we slipped back in progress but delay.
Apologies, can I check which section we're referring to? Lovely, thank you. Sorry, my apologies. I'm struggling with my own technology here. So the section we are looking at is perfect. So the stewardship code. We are at this point in time. We are targeting October 2024 for submission to the FRC. Clearly, this project has been quite significantly delayed. So it's marked as outstanding for Q1, as we had hoped to have at that point completed some work involving the RI working group, which has yet to be completed. We are trying to set a new date for that working group, to hopefully be able to move this work item forward.
Councillor Bafo.
Yeah, page 83, the last page where it says no pension board meeting have been held since 2022. This means that the legal requirements in relation to the board responsibilities are not being met. Is that still the case, or there has been any change or improvement?
So the key challenge that we've had with the pensions board has been around membership. So essentially what happened to the board is the board had previously had the full complement of 4 members. Unfortunately, within quite a short space of time towards the end of the previous financial year, we had all 4 members leave. Well, no, we had 3 members in place, and all 3 left over quite a short period of time. And I would emphasise that they left for entirely unrelated reasons. But what that did is it left us entirely without a pensions board. So it has been quite challenging to recruit sufficient new members to be able to now appoint a new board and hold a further board meeting. Where we are now is that we have now appointed a full complement of board members, so we should now be in a position to hold an introductory meeting before the end of the financial year.
And what was the circumstances and in terms of for their departure? And has that been taken into account to ensure that we have a long-term sustainability of the people in place?
So we do have certain particular challenges in keeping long-standing board members in place. So one relates to the requirement to have employer representatives on the board. So one of the difficulties that I think particularly applies to us as a relatively small London fund is that we are required to have employer representatives, but do not actually have that many large employers. So we always look to one employer rep from the council as our largest employer. but we often struggle to find a representative of our smaller employers. And that was the case for one of the departures. Essentially what happened is the previous representative was no longer employed. He changed role, was no longer employed by that employer, and could therefore no longer serve on the board. So maintaining a representative for the small employers, we have always found quite challenging. The departures of the scheme member reps were simply for personal reasons. Again, we do find we also find scheme member representation quite challenging. When we go out for scheme member reps, we do write to our entire membership, which is over 25,000 members. Generally, we receive fewer than 10 responses, and not all of those people will be able to fulfill the requirements of the role. It is quite a challenging role. There are legal requirements in place around knowledge and skills, and it is simply quite difficult to find people who are willing and able to volunteer. And that, you know, I don't think we are the only fund who've had challenges around appointing board members. I think we were particularly unlucky to have all of ours go at once.
Sorry, Chair. I think there's a greater concern when it comes to board membership, and it becomes something like chicken with our head, and it becomes a bit of an issue when you are running organizations like this. And I think it will be better to see what is missing and how things can be put in place to get some best ahead and running.
Councillor Chapman.
Thank you, Chair. Can I just ask a general question? Is how 2 points actually. Is how do we choose which items are included in this list? And has any, or 3 questions. Has any thought been given to you know, because some of them have much more impact than others, don't they? Is there any way we could sort of flag out what might be key and what might be not so key? And the third one is, while, you know, on the basis of my knowledge, it seems to have done a fairly you know, honest, appropriate judgment of what the situation is. How do you actually come to these you know, indications? I mean, are there actually measures in place, or if it's a subjective judgment, is there some challenge to process to that?
Sorry, Councillor Chapman, can I just check, is your question relating specifically to the business plan and the business plan actions? Perfect. No, thank you. It is. Yep.
So how do we choose which items go in that? That subdivided to, and you know, it strikes me as some of them have much more impact than others. Is there any way we could sort of focus on those which you know, are more concerned to committee or not? And the second question was, where's subjective judgment involved in assessing where we are on it? You know, while you know, I'm not complaining because it does seem fair to me, but how do we sort of validate that subjective judgment? Is there a challenge process in place? Who does it? You know what I mean? Is there a scoring or what?
So in terms of deciding what goes onto the list, business planning is an annual process. We've followed a couple of different processes for setting the business plan in the past. So we have, you know, we have in the past actually held an entire business planning day and invited the chair of the committee. That's something I think we'd be happy to look at doing again in the future. For the setting of this year's business plan, it is something that essentially we sit down and discuss as we've sat down, discussed as officers with our governance advisor, and with input from other advisors, sort of what we think the key work items are over the next year. As you say, some of them are probably more impactful than others, but sort of everything that makes it on there is something that we think it is an ongoing activity that we think it is worth reviewing progress against. So I appreciate that some of them are smaller than others, but really what we tend to put on there for tracking is anything that really sits outside of sort of our standard annual processes. So any sort of longer term project that we have in place will generally go on there, and we also obviously add on there anything that's subject really to triennial review. We have, as I said, we have sort of gone through different processes to agree it in the past, and I'm sure that it's something that sort of the fund could look at. How exactly you want to sort of design and agree the business plan. In terms of how we monitor our progress against it, so it's done by a few different people, and generally speaking, we try to err on the side of caution in terms of sort of representing what we've done, and making sure that we can justify that when it comes to pensions committee, because obviously sort of, these are all ongoing processes. It will become apparent if we don't complete them. So it's very much, we try to make sure that we're in a position where we're not having to sort of suddenly change the status of an item. Is how I would describe it.
Thank you. That's better, isn't it? Can I go back to the pension board issue, please? Does this mean that Sam has now gone? So am I
yes, it
able
does.
to be told the name of the new chair? And also, can you give me, as the scheme member representative on the pensions committee, a little bit more info about the scheme member representatives on the pensions board, please?
So it does. So Samantha Lloyd did step back from her role as chair. In terms of a new chair, we are most likely going to pursue an interim chair for the board, and in due course, essentially, we will hold a couple of board meetings and make a decision as to whether the new board requires an independent chair, or whether members are able to select a chair from amongst the representatives themselves. Use of an independent chair isn't uncommon in the LGPS. We didn't previously feel the need to do so, as we had a scheme member representative who was more than able to act as chair. Obviously, we are now looking at a completely new board. So it is a different board with a different range of experience, and it may be that we decide to look towards using an independent chair instead of selecting from amongst the membership, and that's something that we'll decide, I think, over the coming months. In terms of the scheme member representatives for the board, one has come simply from the wider membership, but has previous experience in the Treasury team, and the other has been put forward by the union representatives.
Councillor Ozin.
Chair, Rachel has already answered about the representative from the unions. Thank you.
Because just one clarification from me. When do you think the cyber induction training for all newcomers, pension committee, is going to take place?
I have to admit, Chair, I cannot say exactly when it will take place. we can look to provide you with an update on that in March. With apologies to Michael.
I don't have my glasses on, so bear with me. If I ask the wrong question, tell me it's the wrong question. That will not work. The question is that it's about the new code. You know, kind of made reference to new code here. What are the underlying legal, requirements for the new code? Any idea, or
Are we referring to the pensions regulators' new single code of practice? Essentially it is a whole suite of requirements relating to the governance and administration of the fund. Catherine will have a better memory than me for when exactly it is coming into force. Is it? Thank you. It comes into force on the 27th of March. So essentially, it's already been laid in Parliament. So it is sort of now available for consideration. It comes into force, as Catherine says, at the end of the month. Back when there was a public service code of practice, we did used to do an annual update in terms of the fund's compliance with various aspects of the code, which again looked across sort of the full suite of the fund's administration and governance. So it looked, it's very much focused on, on our compliance with regulation and on topics such as the pensions board, on training for the committee and board, on compliance with administration regulations. So essentially, it is this is a new this is rather than public service specific. This is now a new generalised code which has been developed by the regulator, which will apply from the end of March. So the intention is to start that annual review process again, so that once a year the committee is checking the fund's compliance against each aspect of the code.
Just for correct me if I'm wrong, just for the benefit of the members. So this single code is the combination of all the 10 codes to one, is that right?
Again, I can't remember how many codes there were to start with. Catherine might tell you.
Yeah, so the regulator is combining about 15 codes, but the majority of those weren't actually relevant to the public sector. Quite a few of those codes were only for the private sector, whereas this is bringing together all of the regulators' private and public sector codes just into one, because it's easier for them to manage that way.
That one. Sorry. What sort of penalty will be imposed if the underlying requirement is not met? The legal requirement, if it's not met, is there any penalty that's going to be imposed, or just reporting only?
I think it depends very much on what the nature of the breach was and how a fund reacted to the breach. So the regulator, certainly in the past, it has used its role to work with funds in the first instance before taking enforcement action. So, for example, we as a fund have previously undergone an engagement with the regulator around the provision of membership data to the fund by the council. We had difficulties over a number of years as a result of the problems in producing timely annual benefit statements. So we therefore had to make a number of reports to the regulator. When it was clear to the regulator that there was a pattern there and that we were having difficulty in resolving the problem, they did meet with us and engage with us on how, what our plans were for resolution and how we were looking to take that forward. And that ultimately did not result in enforcement action. Clearly, sort of, if the regulator finds that funds are not working with it and not cooperating with its efforts to engage, then it will look to enforce. But it's certainly in the past, its policy has always been engagement in the first instance.
Any other question from members? Anybody? So my last one, if it's under this one, correct, like I said, I don't have my glasses on, but I'm going to ask that question. It's not to do with the code. This is, when is this smaller employers admission policy going out to the employer for consultation, and how long will it be?
So the admission policy, I will need to check if it has actually gone. It is certainly due to go out around now. I can come back to you with whether or not we've actually begun the consultation process. We are hoping, it is hoped that we will be able to bring it back for the end of March. Alternatively, we could look to June at the latest. But it is something that we would like to make sure that we have, as it's not just employers who are affected, it's the council schools. So we want to make sure that we've had that engagement with the schools and that they have understood the impact that this will have on their procurement processes.
Any further questions? If not, we go to the recommendation. So could the members agree the recommendation? One, the progress against the business plan, task and action, and agree budget, the current measures on the strategic objective scorecard, the risk register and the risk identified, the breaches register. Can you please agree that, members? Great, thank you. So we are now moving to agenda item 10, quarterly update report, page 77 to 138. If you have the hard copy. This report provides an update on performance across the following key areas since the last meeting. Rachel, could you please introduce the report? Thank you.
Thank you, Chair. As Chair set out, this is the quarterly update, which for funding and investment. This covers the period to, let me check I've got this right, September 2023. And then for other aspects, it does run up to the end of December 2023. There are a couple of areas that I would like to highlight to the committee, and I'd also like to shortly hand over to Sam to deliver the market update. A key point I'd like to note in the investment section is to note the ongoing performance issues around the ELSIF funds. Each of those, so a number of those, in particular the Global Alpha Growth, Paris Aligned, and the Sustainable Equity funds, have seen now really quite a lengthy period of underperformance. We saw ELSIF in September to discuss the performance of those funds, and it was agreed that they would return to the committee in 6 months for a further review. So we are intending to invite them back to the March committee for a further update. And then if I could hand over to Sam for the market review section.
Thanks, Rachel. So we're just going to jump ahead actually a little bit in the pack to slide, it's page 129 onwards. Sorry, 1 second. Okay, I'll bring up this one. Yeah, thanks. So I'll start on slide 131 and then just go through slide by slide if that's all right, and just kind of go through as we go along. So key narrative, sort of what's been driving markets over the last quarter, and indeed really over the last couple of years, as we know, has been inflation and interest rates. Last year, we started the year with very, very high level of inflation, double digits. But towards the back end of the year, we saw inflation come down to more manageable levels, kind of between 3% and 4%. And that's really where kind of markets would expect inflation to stay for a little while. So still reasonably meaningfully above the Bank of England's target, which is 2%, but kind of nowhere near earlier on in the year. and kind of getting under the hood a little bit with those. We've seen things like food inflation, energy inflation come down a lot, which is driving what we're seeing in inflation. But we still have things like services inflation and wage growth, which is reasonably strong, which should mean that actually that final bit, so getting below that 2%, might be quite difficult for central banks to achieve. So on slide 4 is interest rates. What we've seen is that rates have stayed actually pretty steady over the last kind of 6 months or so, and really we've hit a bit of a peak in interest rates. Central banks have largely got inflation under control, as I say, didn't want to raise higher, but also now aren't in a position where they feel that we could raise rates straight away, which is why they've been pausing. What they want to avoid is a situation bring rates down too soon, and what we see is a second spike in inflation. Actually, interestingly, for the first time ever at the Bank of England Monetary Policy Committee, we had voting members voting for both a rise in interest rates, holding interest rates, and lower interest rates at the same meeting. So really, even they don't know what's going to be happening with these interest rates. In terms of how the markets view things on slide 5 or 133, the markets are expecting interest rate cuts relatively quickly actually over this year. So probably cuts in the region of sort of 1 to 2% by the kind of back end of 2024, expecting that the market can get inflation under control and can largely avoid a recession. Turning to equity markets, the key driver of returns, obviously, for the fund. We've seen pretty strong performance in equity markets over the last year, and particularly over Q4. That's been driven, as it has been across last year, predominantly by the US, and we've seen emerging markets really kind of lag. And that's particularly come through with economies like China, where there's a lot of concern around various issues with the Chinese economy, demographics, etc. But looking at the US,
Sorry,
sorry,
just for the benefit of the members, I'm not saying you don't know, could you please clarify the Magnificent Seven? So that they know when it's a Magnificent.
yeah, absolutely. So on slide 8, we start talking about this Magnificent Seven or Super Seven, you might have heard it called. These are effectively the enormous US tech names, so the likes of Meta and Tesla and Apple and Microsoft, that have really been boosted very, very strongly by this sort of AI revolution that's come through in 2023 and have seen their share prices absolutely soar. And you know that can bring some problems. So on slide 9, there's a graphical representation of just how large these stocks are now. So actually, these 7 stocks are larger than the combined stock markets of the UK, Canada, and Japan combined. Global index now. That means that there's concentration risk now. So this is a risk to global markets, for example, if there's bad earnings call from an Apple or a Microsoft, for example. Also, interestingly, you know, this year, well, that actually active management's been quite difficult because they are the largest stocks in the passive index. Therefore, they have a reasonably large holding to them, and they performed extremely well. The active equity managers who haven't held these stocks or haven't held them in the same proportions have naturally underperformed them. Quite a difficult year for active markets, for active equity markets in this space. And that's one of the kind of fallouts from when we see market dislocations of this size. Just on slide 10, a little bit wider in terms of the equity markets more broadly, we're seeing the US market is quite sort of richly priced. Emerging markets kind of less so. Again, the US is still driven by some of these very large tech names. They're on some ratios like price to earnings, for example, actually these tech names are as high as the technology companies in the early noughties in the tech bubble of the original kind of 2000s. Moving on to fixed income, in the next couple of pages. The last couple of years have been absolutely disastrous for fixed income, for bond assets, as a result of what we've seen in terms of changing interest rates. Actually, Q4 really reversed that trend. So there's 2 sort of key drivers in terms of the absolute return of a corporate bond, and that is the spread, which is the difference between the return on a corporate bond, which has been issued by a company, and the yield on a government bond. Where that spread comes in I'm looking at page 13 now. When we see that spread narrow, it means that corporate bonds outperforming government bonds. So not only do we see that spread come down, but actually on slide 14, we've seen government bond yields come down. Now, because bonds have interest rate sensitivity, when we see these rates coming down, that is positive for the performance of the bonds. So this is a really good tailwind for bonds over Q4, and those assets perform very strongly. Obviously, that's reversing a much wider trend, which went the other way over 2023. Just looking at 2024, this chart on slide 16 is just talking about, you know, how rosy is basically the market outlook. So the market seems to have digested all of this volatility very well. It seems to think that the markets actually can deliver this, what they call a soft landing, i.e. that the markets can avoid going into recession. They can keep positive growth, but at the same time, they can get inflation so good. But of course, that's not necessarily going to continue that way. So we've seen equity markets, for example, get off to a pretty mixed start. Global markets in the US kind of largely flat. China's taken a bit of another beating to kind of continue their trend from 2023. In the fixed income markets, I won't go into this in too much detail because we have got a pack later on which touches it on a little bit more detail. But again, we've kind of seen some spreads come down, yields go up a little bit this year. Actually, is this just a smaller kind of longer term trend, and we've just seen a huge amount of volatility around that effectively. I'll just jump onto the penultimate slide, which is slide 20. Given this is the beginning or the first meeting properly of the year, we thought it might be useful to include this slide. We can often kind of talk about the level of volatility in the shorter term movements in markets and what's kind of going on. We talk about inflation, about interest rates, but actually this slide is looking at the much longer term, more structural trends which drive markets. And really these are more important because Hackney is of course a very long term investor. And if we think about what's happening in 2024 and maybe the 2020s more broadly, it is a difficult period. And as we look forward, we do think that the market's going to be particularly volatile. Obviously, we're seeing a lot of geopolitical risk on the markets. We've seen central banks take a fundamentally different approach than what they were taking, for example, in the kind of 2010s. We've seen inflation much higher years. And so there's lots and lots of trends that are going to act as a headwind. And also some trends which are kind of will stay, things like demographic trends, for example. In slide 22, just the sort of key takeaways. The first is that monetary policy, so interest rates and inflation and how those two interact, is likely to be a key driver of markets. Each time we see some news, markets jump accordingly. We're not expecting that to change. As I mentioned on the equity side, increasingly we're seeing this big concentration risk, these large technology stocks. It's more important than ever that the fund kind of maintains its diversification, both across asset classes, but also within equity as well, which it kind of does. And then finally, from a sort of risk perspective, we're seeing these geopolitical risks. We're seeing these risks from central banks, from technology, from the transition to a lower carbon economy, for example. The portfolio diversification that we have now is likely to serve the fund much better, effectively, than it has done over the last decade, for example, where effectively everything just went up, right, because it's forward. And I'll pause there before Jill comes on to the quarterly report, just in case there's any questions.
Yes, Jonathan.
Dan, that's fascinating. Can I just ask, the indexation globally is at 40% of markets. That's obviously a big factor in terms of the growth of this phenomenon, the Magnificent Seven. Getting poor earnings reports from these Magnificent Seven, it hasn't happened. I can't see a reason why it should do, but if we do, what is that going to do to market levels?
Yeah, I mean, the short answer is that it's going to have a big impact, and not just in the valuation of those companies themselves, but a huge driving force behind markets last year was the expectations that AI is going to be transformative for the economy. And it may well be. But if markets decide that actually too much hope has kind of been factored into to that outlook, then we could see quite substantial fall-offs, not just in those technology names, but kind of across the sector. So, you know, it's hard to kind of to quantify that, but they're now a reasonably material proportion of the wider MSCI world. They're coming up to between sort of 5-10% of the overall index. So, you know, small changes in those companies can have a big impact on the equity index for sure.
Chapman?
I was going to ask about the funding level, which I know was reported 137%, which is excellent. I know this is largely to do with the discount rate, I think, because I also see that's moved from 4.3% to 6.6%. A bit curious about the move in the discount rate. But the question was, I mean, is a funding level of that level, does that now trigger another, I know we've only just looked at it, but another look at our investment strategy in terms of potential further de-risking or, you know, to bed that in somehow or other?
Yeah, I think that the difficulty with the discount rate methodology, and this is probably more one for the actuaries than Reddington, but it does mean that the funding level is relatively volatile. So we have seen up to 136%. I don't know what the more recent figure is, but because we've seen yields come down, we would expect the funding level to have come down quite meaningfully as well. I haven't seen a more recent figure. The problem is making larger strategic decisions is difficult. So we want to be sensible and we don't want to take more risk than we need to. But at the moment, it would be quite hard against that backdrop to be making kind of more fundamental changes, I think, to the level of risk or return that the fund wants to take. If that makes sense.
Just to follow up, sorry, on what Sam said, the ending sort of the reported funding level, because that goes up to September. I think it did tick down, but it had moved down by December, but then obviously has ticked up again a little bit in January. But as Sam's pointed out, that is, you know, very, very heavily linked to changes in gilt yields, and it doesn't necessarily, you know, it isn't necessarily a reflection of sort of the long-term direction of the fund.
Councillor Chapman?
So does there come a point when we we'll need to look again? You know, we used to have specific trigger points, didn't we? I don't think we do it that way now. But you know, at some point we will need to look again, won't we? When might that come, and what might be, without setting a trigger, what might be the indications that lead us down that road?
Yes, I mean, we may not have the kind of formal triggers that you might have had previously. We do kind of have informal triggers. So when we do the investment strategy review, we look at all the different kind of risk faces. And one of those is the expected return we have on the portfolio versus the required return. And the required return is a function of what your funding level is. So effectively, what level of return do you need to hit your objective? So naturally, if the funding level is higher, then the required return that you need falls. So when we look at that, and if we see quite a big gap between the two, it does make sense at that point to bring the return down, as you say, and bank some of those gains. Absolutely, and that's something that we do look at.
Thank you. I had one question on another issue on this report, if I.
Yeah, go on.
Yeah, yeah, it's a bit. I was looking. Sorry, I didn't write down the page number. I was looking at performance of the various investments in the table there. And unless I'm mistaken, it looked like some of our index funds were under the benchmark. I just wondered how that's possible, because presumably the index is the benchmark, and if you're tracking it, you know, something's going seriously wrong if you're not in line with it. Have I misread that? Sorry, if we can find the page, it would help, wouldn't it?
I think it's page 121. Is that the one that you're looking at? For BlackRock.
Yes.
Yeah, 121. So over the 3 years, they've actually done slightly better than the index. Yeah. So the Passive BlackRock fund has done slightly better than the index. And you might expect, I mean, you would expect them to perform very much in line with the index, but they can do some additional things which might either boost performance a little bit in terms of timing index changes and implementing those, but also in terms of they can also do stock lending on those portfolios. You might often see a 0.1, 0.2% variance, but in this instance, it's just slightly higher than that. So they've done a little bit better than the index. If it would be helpful, I can come on to talking about the performance in a bit more detail.
I think that's okay. Yeah, just I just have me thinking to what extent index funds were really indexed, if you know what I mean. Anyway, okay, thank you.
Any other question on McLeod disclosure communication? McLeod discussion, page 99. The new rule for October, the new rule from October 2023 constitutes a material change to basic scheme information, and which requires us to send leaflet to members to inform them of the scheme regulation amendment made in order to implement the McLeod remedy. So this leaflet, how do we know that it's gone to everybody? And if people did not receive the leaflet, what is the implication of that?
So whenever communications are sent out from Equiniti, a copy of what's been sent is uploaded to essentially the document store for each member's file. So what we do is the team carry out some spot checks on member records to make sure that the documents are correctly shown. What we also do is we do a little bit of spot checking around essentially usually various other people who work on our floor to check that people have received leaflets in the post around the time that we expect them. I can confirm that I've received my McLeod remedy. I've received my McLeod remedy leaflet, and I know that the spot checks that the team did to check whether others have, it does appear to have been received. Obviously, if we did find in the course of spot checking that we found a lot of people reported not receiving something, or that we weren't able to see copies as we expected on the members' document records, then obviously we would need to pursue that with Equiniti and start looking for proof of postage, making sure that had been sent as we expected it to have done.
My second question is, correct me if I'm wrong here, it's about the, I think there's a requirement that we need to create a dedicated section on our website for McLeod. Have we done that?
So we do include, we have included certain items relating to it. What we do need to do is carry out a review of the documentation on our website. At the moment, there is not a McLeod specific. That is something that ought to be reviewed, and it is something that we should be making available.
For that, any further question from members? Henry, have you got any question? You're a bit quiet. Is he online?
Can you hear me? Because I'm having real problems with connectivity.
Oh, your problem with connectivity?
Yeah, can you hear me?
Yes, we can hear you.
Yeah, okay, I think I'm just looking at this chart that's on the screen at the moment. I just wondered when we get there if somebody could have could tell us what's happening at LSIV, because almost every single one of our holdings has not performed against its benchmark. I just wonder if Readington could pick that up and see what's being done to try and bring LSIV up to up to standard.
So I don't know if anybody else wants to come in, but I think there's a few things. Really, there are a few issues with some of this performance. This performance is up September. We don't as yet have the data to the end of December. I think we're particularly looking at the global equity funds and the diversified growth funds. So effectively the active funds that LSIV run on your behalf. Sam has touched in his market update, the headwinds that equity managers have been up against, particularly with regards to the Super 7 technology companies. Say that the sustainable equity funds, probably less so the Global Alpha, don't necessarily have index level exposure stocks, which would have impacted performance. Just in terms of what LSIV are doing about it, they obviously have regular reviews with the managers. They have recently put the Diversified Growth Fund onto their enhanced monitoring. They haven't put the equity managers on. So I think Rachel's suggestion that you have to come in and report on how they're going to take things forward. I think the other point to perhaps bring out is that there is a new Chief Investment Officer that has been appointed at the London CIV. She has very strong experience of investment markets. I suspect that this will be one of the first starts to think about reviewing what's been happening with performance. As Rachel said, we can, going forwards, look at how the fund does investment governance or reviews some of the issues around the London's and CIV performance, but certainly the equity funds have been tailwinds that Sam was talking about. I think, you know, it is disappointing clearly that I mean, you're always looking at funds over the longer term rather than just that short-term performance. But even over the longer term, particularly the LSIV Sustainable Equity Fund, having had a reasonable performance at the outset, is now significantly below the water, which is disappointing. I think it's a case of what are they doing to monitor those. It doesn't seem that they've got any of these managers on enhanced monitoring, which you might expect given performance. So that might be something that gets raised at a meeting and could be picked up, I think, by the committee. Very recently, LSIV come in to talk to committee. Sorry, just one other comment I wanted to come back on in terms of the strategic asset allocation, if that's okay. Obviously, we did the review sort of 12, 18 months ago. I think we had certainly looked to take some equity risk off the table, which was part of the overall plan, to put some more into fixed income, so the multi-asset credit, but also look at how we could further diversify the portfolio. Some of that is still in train, partly because of fund launches at the CIV, so you will be, I think, implementing that over the next few months. But so it was factored in, but you're right, markets have gone a lot further, and sometimes it's as well to pause and sort of have a look at things. But and maybe we could update the pension risk management framework so that we can come back and see if there's any triggers that we should be speaking to you about. Thank you.
Councillor Chapman.
I think Jules covered all the points I was just going to refer to the fact, as your representative on the CIV, that we have a new chief investment officer, and I think you just basically agreed with trying to invite her along to a future meeting and, you know, discuss the issues they had and the new approach, I think. Okay, thank you. Thank you.
I think that's noted. Jonathan, please.
Thank you, Chair. Is this the moment for us to start considering other pools? And is there any evidence that other pools have managed this volatility in markets that some London funds have had a bad time with?
I think consideration of other pools would certainly be a challenging approach at this point in time. I think because it would not simply be would we consider other pools, it would be would other pools consider taking on additional clients. And of it, you know, that is something that has, you know, I think has been discussed previously, albeit probably not by Hackney. You know, whether or not I think consideration of whether or not it's feasible might limit discussion of that approach. There's also, I suppose, any likely response from government to take into consideration. At present, does not appear. It certainly does not appear to be their intention that funds are able to transition at will between the different pools. That is certainly not my impression of their intentions, anyway. I don't know if anybody else has got anything further to add to that.
I mean, obviously there was the consultation last autumn, and which I think is covered in the covering paper. Further guidance from government, particularly with regards to pooling. I think it's probably interesting to note that the recent policy paper put out by the Labour Party around pooling is that they will perhaps look at a broader range of options, but I think that the requirement to pool is still going to be there, and pressure to continue. So I think it's perhaps getting assurance over the governance arrangements and how they actually make decisions at London Civ is probably an appropriate way forwards.
Any further questions? Recommendation is for committee to know this report. Can we know the report, please? Oh. Emery, sorry, I can't.
Yeah, no, just I guess we're stuck with the London Civ, but it seems to me the question that we should ask them when this lady comes to see us is it better for us to be in managed funds or tracker funds? Because it's always pretty hard to beat the index. And it seems to me if the rationale for going into London Civ was partly all about fee reduction and looking at what they've done against these benchmarks, the argument or the question I would like to ask them, and I think we ought to consider, is whether it would be better in the long term to move some of our LCIV holdings, assuming our asset allocation is right, which it probably is round about right. Should we be looking at tracker funds, which by their nature are going to be much cheaper to follow, and ultimately, if we're long-term holders, if we can perform with the index, we're probably not doing too badly. So that's really the question I would ask them. But that's for the future, perhaps.
Go on, Sunny. You want to have a go? Question?
I guess the active-passive debate has been one that's been a very long debate, and certainly when governments started out on this pooling journey, there was some suggestion that funds shouldn't have active management, but should in fact have everything passive. I think there are active managers that have been able to add value. The particular problem, I think, is that the fund has very high exposure to growth managers, which have been particularly impacted by sort of some of the headwinds around technology stocks more recently, but also the kind of rebound in commodities and resources stocks. So there's been some headwinds, particularly on more sustainable type funds as well. But yeah, it's a valid question.
If we don't have any more questions, the recommendation is for the committee to know this. Thank you. We are going to move to the exempt part of the minute in a minute. Before we do that, I've got an announcement about Rachel. She will be leaving us at the end of February. She's been working with us for 16 years. Correct me if I'm wrong, Rachel. So, slightly less than that. So we, on behalf of the committee, I give our sincere appreciation and thanks for your support and all you've been doing to, move the pension, funds forward. So thank you. If anybody wants to pay any tribute, you are welcome to do that. Councillor Chapman.
Thank you. Can I, as your predecessor, unworthy predecessor as Chair of Pensions, if I could just add my thanks to Rachel, who's been with us, a fair time now, and has done a fantastic job, not only overseeing our, as I keep saying, our, our brilliant and front performing climate policy over the last 7 or 8 years, but also seeing, improvement in the performance of the fund and managing a really tight ship in which is a difficult and very regulated area. Done a really, really good job. But I would offer my thanks and the very best wishes for the future.
Want to say anything? Any more tributes? Thank you, Rachel, for your support and for the hard work that you put into our pension funds, and wish you all the best on your new endeavor.
No, thank you, everybody. That's very kind, and I am really sad to go because it has been. I started at Hackney in 2009, so I've been here a long time, and I'm very sad to be going. It's yes, moving on to something different.
Sorry, thank you. And can I just check that we'll be making a note of our thanks in the record of the meeting? Yeah, thank you.
You'll be missed. So we are moving to the next exclusion of the press and public. Proposed resolution that the press and public be excluded from the proceedings of the Pensions Committee meeting during the consideration of the exempt item 12 to 15 on the agenda, on the ground that it is likely, in the view of the nature of the business to be transacted, that were members of the public to be present, there will be a disclosure of exempt information as defined in paragraph 3 of part 1 of Schedule 12A of the Local Government Act of 1972. So agenda item 12, Equiniti contract update, page 1.